Hello everyone. Hello everyone. Welcome. So we are continuing this topic. My name is Animesh and we are doing revision and practice sessions, right? We have done various sessions. You have seen my videos earlier also. So we are doing topic wise and today's topic is India's fiscal system, correct? So I hope I am being audible and visible as understanding the fiscal policy in India, correct? How the fiscal thing works. Okay, so let us start then. And, first thing to understand is there are two things. One thing is fiscal and one thing is monetary. We'll see it again in the video, but just to explain, this is handled by the government and this is handled by the RBI. Okay, fiscal, government, monetary, RBI. Okay, uh, fiscal system deals about total expenditures, receipts, budgets, to taxation, all these things which take care of India's economic health, fiscal health, okay, which keeps a balance between what is going and what is coming. So that is what is the fiscal system, okay. So if we see the mechanism, the fiscal policy, the fiscal policy, the policy decisions of the government concerning public expenditure, taxation, and public borrowing. So it deals with these three things: expenditure, taxation, borrowing. Okay. Now, how does it happen? Next question is how, correct? So the primary mechanism used to adjust spending and taxation levels to influence overall economic activity and promote growth. This is the fiscal measures. These are the fiscal measures. These are the primary mechanism, correct? That how much taxation, how much tax revenue we are getting, how much we are spending on the public, what is the capital expenditure, correct? What is the current expenditure, all these things. From where does this come? What is the origin of this? So the origin for this is Keynesian economics. John Maynard Keynes, correct? It is rooted in Keynesian economics, which argues that government intervention is necessary during periods of instability. This is very important. Like Adam Smith talks about free markets, free market, free economy, open market, least or nil government intervention. Because Adam Smith, he used to think that market forces can balance out the prices depending upon the supply and demand. But Keynes told that government intervention is necessary whenever the balance is off, whenever there is instability. Okay, I hope I am being audible and visible. All good? All good? Okay. ठीक है? So increasing spending or cutting taxes to boost demand during recessions, reducing spending or raising taxes in inflation. So these are the prescription. Medicine का होता है ना, prescription is there. This is the prescription. We'll see this in a while. What does this mean? This we'll see now. Okay. So I hope till now you are clear with what is the fiscal system exactly. Correct? Simple. What is the fiscal system exactly? So we saw about the fiscal system. Now, there are two major mandates of the fiscal policy. First is inclusive development, and second is macroeconomic stability. So, first, we'll try to understand what is inclusive development. Inclusive comes from the word inclusion, to include, to include maximum people into the mainstream development so that the development is uniform across the society. Okay, so that the development is uniform across the society, across the territory of India. So maximum people should get included in the development programs, development policies. For that, mobilization of resources is important. Means channeling funds into health, education, and infrastructure. Correct. So whatever funds I'm having, whatever corpus I'm having, I need to channelize it into health, education, and infrastructure. Correct. Then raising living standards, employment generation, social welfare, income level. Correct. These things should be increased. The fiscal policy has two mandates. One is inclusive development, one is macroeconomic stability. In inclusive development, these are the sub mandates. First, to mobilize resources. Second, to raise the living standards. Now, if a person is having a certain level of income, health standard, and education standard, it is the responsibility of the fiscal policy to increase that standard. So you can say human development indicators, they have to increase. Okay. Reducing inequality. So minimizing disparities via progressive taxation and redistribution. What is progressive taxation? So people who are having just I'm giving an example, not quoting the exact percentage, just an example. People up to 15% will pay 10% tax. People up to 15 lakh per annum income will pay 10%, suppose. Up to 20 will pay 15%. Beyond 30 will pay 25%. Means as my income is rising, my tax percentage is also rising. That is called progressive taxation. As your income rises, your tax percentage also increases. So what will happen? The government will get some revenue out of that tax, right? They will earn tax, no? People will pay tax to the government. They will have some fund that they will redistribute for the needy ones. How that redistribution comes? How this comes? This comes in the form of schemes, central sector schemes, centrally sponsored schemes, state government schemes. So this redistribution happens in terms of schemes. Okay. And also in inclusive development talks about encouraging private sector, creating a conducive environment for private investment, foreign FDI, foreign direct investment, foreign institutional investment, FIIs, foreign institutional investors, right? So this is the first mandate of the fiscal policy, that is inclusive development. But can I just concentrate on this only? No. I have to create a balance. I cannot go just beyond development at the cost of the economic stability. that is neither feasible nor advisable. Correct? So I have to take care of the second mandate, that is the macroeconomic stability. Now, what is macroeconomic stability? When I talk about my income, my budget, my expenses, my borrowing, that is microeconomic. That is micro. But when I talk about national income, national budget, national borrowing, that is macroeconomic. It is at a macro level. So economic stability, countering cyclic fluctuations. We'll see this now. What is this? So a cycle is going on, correct? A cycle is going on. So government tries to counter it so that balance is achieved. Okay, correct. Now there are two types of it: pro-cyclical, anti-cyclical. We'll see this in a while. What are these pro-cyclical fiscal policy and counter-cyclical fiscal policy? Okay, anti or counter-cyclical. You can write counter-cyclical. So these are two: pro-cyclical and counter-cyclical. Okay, price stability. So controlling inflation and ensuring stable purchasing power. Now you can say, sir, this is so done by RBI. No, it is done by government and RBI both. If the government reduces the tax very much, a lot of money will go into the market and the inflation will start rising. Correct? So price stability is very, very important. This is a job of RBI and government both. It is into the job role of both of them. Okay? Okay. Sustained growth rate, maintaining a consistent balanced trajectory. So if the India is growing like this, so they have to maintain this rate. It cannot be like it can come like this and though go like this. No, not possible. It has to be upward trajectory. The growth rate has to be maintained. It is not that India can grow in 1 month 2%, next month 8%, after that 1%. No, they have to maintain a percentage growth rate. Okay. And one of the major is balance of payments, preventing excessive foreign capital dependence. There is current account and capital account. So we have to maintain a balance between these two also. Okay. This balance got disturbed during 1991. We had a balance of payment crisis. Correct. At that time, the fiscal policy, monetary policy, both were suffering, because of which India's forex and other things suffered. That is different. Okay. So the Indian fiscal policy has two mandates. First, inclusive development. Second, macroeconomic stability. Okay. I hope we are clear till here. If any doubts are there, you can just put it in the chat. Okay. Chalo. Now, for fiscal policy, what are the levers? Or you can say, what are the tools? What are the tools? Correct. What are the tools? First, public expenditure. Like we have monetary policy tools, I had explained you in the previous videos. Same way we have fiscal policy tools. First is public expenditure. How much ever the government is spending in the public to make bridges, railways, correct? Schemes, providing food, education, all that. So government spending on goods, services, infrastructure and welfare. This is public expenditure. Application, direct injection to alter economic activity. So what government can do? Government can increase public expenditure. If they increase the public expenditure, if they increase it, more jobs will be created, more production will happen because more demand will be there, supply will be increased, so country will grow. Correct? So public expenditure is a very important tool. Now, this doesn't mean that government will start spending endlessly. No. Okay. So the first tool for fiscal policy is public expenditure. Now, public expenditure is done on the basis of Niti Aayog's policy also. Niti Aayog also recommends on this, and Finance Commission also. And Finance Commission also. These two combined, majorly Finance Commission. Majorly Finance Commission. It recommends the expenditure. Earlier, this job was done by Planning Commission. Okay. Earlier it was done by Planning Commission. Easy. Okay. Second tool is, first is public expenditure. Second tool is taxation. Taxes. Correct. It is the most powerful tool influencing disposable income, investment, and savings. It is the most powerful tool influencing disposable income, means whatever I can spend, which is not committed or which is not a liability. That is my disposable income. Investment and savings. Application, it reduce taxes to spur growth, increase to curb inflation. Simple, I'll tell you. See, if tax is 5% right now on your income, suppose you're spending, so your income is 1 lakh, suppose 1000 rupees income you have, correct? है ना? 5% tax means 50 rupees you're spending, 950 you have to spend. Now, government increase the tax to 10%, means you have only 900 rupees to spend now. So 50 rupees reduced. Now only 900. Like this, there are lakhs of people. For them also same thing happened. So what happened? Your spending reduced, expenditure reduced. This is done to control inflation. This is done to control inflation. And if inflation is very less, if deflation is so, taxation is reduced to increase liquidity. Okay. So this is the second part, taxation, GST, and income tax. These are very powerful tools. Okay. Third is public borrowing. How much are we borrowing from? Sourcing funds internally or externally when expenditure exceeds revenue. Correct? How borrowing, obviously when you are in a family, sometimes you might be less on money. So what you do is you borrow. Now nations borrow in terms of bonds, treasury bills, national saving certificates. Correct? So these are the three tools for fiscal policy. Okay. Fiscal policy is what? Indian fiscal system deals with government, Ministry of Finance. Okay. It influences, but wait, I'll just explain parallelly. Monetary policy is dealt by RBI. Fiscal, government, Ministry of Finance, monetary, RBI. You might think, sir, RBI is also in Government of India only, no? Why they are writing separately? Because here it is handled by Ministry of Finance. That's why. RBI doesn't come under Ministry of Finance. RBI is an independent regulatory body. Okay. Core objective of fiscal policy is influence overall economic activity to achieve growth and stability. But monetary policy's major is control inflation, monetary stability, liquidity. Primary tools are three: public expenditure, taxation, and borrowing. Public expenditure, taxation, borrowing. Here, primary tools are bank rate, CRR, SLR, RR, repo rate, etc. This is the basic core, or you can say conceptual difference between fiscal policy and monetary policy. Fiscal policy and monetary policy. Monetary policy is handled by RBI. It deals with the money part, currency. This deals, fiscal policy deals in bulk spending, budget. This is the fiscal policy. So please remember, fiscal policy is taken care by Ministry of Finance, government, but monetary policy is taken care by RBI. Just a moment. Okay. The most important part is both policies must work in tight coordination to maintain systematic balance. It is not that your monetary policy is doing very bad, fiscal policy is doing very good, so everything will be very good. No, they have to work together in the same direction. It is not that monetary policy is working this way, fiscal policy is working this way. No, they have to be with the same intent in the same direction. Okay. Now, there are three types of fiscal policy. Okay. In our fiscal system, in the Indian fiscal system, there are three types. First is expansionary policy, same way like monetary policy, expansionary monetary policy, contractionary, and neutral. Expansionary means higher spending is there. You are allowing people to keep more money with themselves. You are giving people more money. You are reducing tax. You are increasing expenditure. So the more money is going into the market. More money is going into the market. Correct? What is the trigger? Why does this happen? It happens because of recessions or economic slowdowns when there is not much market activity. What is the target? It is to reduce unemployment and boost GDP. More money will go into the market means no more infrastructure projects, factories will be built, jobs will be created. So it may lead to inflation if demand exceeds supply. We have to be very careful with it. Expansionary monetary policy stimulates the economy. It acts as a fuel in the engine. Fuel in the engine. It stimulates. Correct? That is called expansionary monetary policy, expansionary fiscal policy. Then contractionary. So this is the first one. Second is contractionary, exactly opposite. Reduced spending, higher taxes. I am taking money from people. Correct? Why it is triggered? Why it is happening? Because of high inflation and overheating point. When inflation is very high, liquidity is sucked out of the market. Correct? Target is lower aggregate demand and reduce fiscal deficit. Reduce inflation. This is the target. Now, what is the warning? May increase unemployment temporarily because I'm taking money out of the market. There is no money left in the market to be spent. So that is why contractionary and neutral means just whatever is going on, just will keep that balanced. It is just to maintain stability, nothing, no changes. Fiscal neutrality is designed to have no effect on overall demand. It will be perfectly balanced. Whatever is going on, let it go on. There is no changes. Okay. Now there are two types of business cycle or policy cycles: counter cyclical and pro cyclical. Counter cyclical means the policy will move opposite to the business cycle to smooth volatility. If the business cycle is expansionary, the policy will be contractionary. What happened? This happened during 2008 global financial crisis. India's fiscal stimulus package during 2008 and COVID-19. So what happened in COVID-19? Everything was reducing. What government did? It led a package. It led a good amount of money into the market. So it is going against the cycle. So it is called counter cyclical. And when it is pro cyclical, it goes with the sentiment. Correct? It moves in the same direction as the cycle. Expansionary in booms, contractionary in recession. When there is boom, more money government will put. Then it will boom further. Okay, it is highly risky and deepens economic volatility and exacerbates social distress. Got the difference between counter cyclical and pro cyclical? I hope you are getting this difference. I hope you are going good. Okay, so this is counter cyclical and pro cyclical. Okay, so see, counter cyclical where it is boom, counter cyclical when it is up. In counter cyclical, when there is a boom, the policy will be opposite. This is during counter cyclical. During pro cyclical, when there is boom, the policy also will be towards booming the economy, towards doing the pump priming. That is called pump priming. So counter cyclical is the stabilizer, pro cyclic is the amplifier. It will amplify. Okay. Deficit reading, the exact difference between total expenditure and total non borrowed revenue in a financial year is called fiscal deficit. This is apart from borrowing. So it is expressed in percentage of GDP. High deficit forces greater borrowing. So it is not good. Consolidation process, improving government finances through prudent spending, enhanced collection, structural reforms like FRBM Act, fiscal responsibility. Correct? To bring in more discipline into expenditure. What is fiscal deficit? When expenditure is greater than revenue minus the borrowings. Okay. So crowding out effect. Just one more concept is there, crowding out effect. So what happens? Government starts borrowing. So the government requires a massive fund to finance its deficit. So they start borrowing. They borrow heavily from the domestic market. But if the government is borrowing, don't you think most of the money will be taken by government only? So interest rates will increase because the money is gone taken by the government. So whatever is left to borrow, it will be costlier. So businesses are crowded out, forced to scale back. So when the government in a bulk borrows, it crowds out the market. Okay. Fiscal drag. What is fiscal drag? A silent squeeze on disposable income triggered by intersection of inflation and progressive taxation. So I'm not able to spend much. My disposable income reduces. Correct? Inflation or nominal income growth pushes taxpayers into higher income tax brackets. Correct? Their purchasing power has not actually increased, only the prices have increased, but only the nominal income, that is because of the inflation, it seems to increase. So a higher percentage of income is lost to taxation, directly reducing disposable income and stifling aggregate demand. This is called fiscal drag. There is not actual money to be spent, it just seems to be there. Okay, so I told you about pump priming, ignition, deliberate injection of funds. Liquidity is increased by the government to stimulate the economy. Correct? That is called economic stimulus. Push, deliberate push. Comprehensive fiscal policy is used for that. So you can say it is an expansionary measure. Okay, expansionary measure. Counter cyclical, I told you, counter cyclical and pro cyclical. Okay, let us do some questions then. Let us do some questions. Which tax was subsumed into GST on 1st July 2017? Tell me, which tax was subsumed into GST on 1st July 2017. Which tax was that? So that was the service tax, right? It was the service tax which was subsumed into GST. Okay, easy. GST came by which amendment? Please tell me in the comment section. Okay, please tell me in the comment section. The Fiscal Responsibility and Budget Management Act was enacted in. So the Indian fiscal system works on this act, FRBM Act. It lays out certain criteria and limits for the budget. When was it laid down? When was it enacted? FRBM Act. When was this act enacted? Quick, think. So it was enacted in 2003. FRBM Act. Fiscal Responsibility and Budget Management. So the government will lay out norms in light of this act only. Okay, next. Which body recommends the sharing of taxes between center and states? See, such an important question. Which body does that? Which body does it? It is the Finance Commission. Finance Commission. It is a constitutional body. Okay, it divides the tax devolution. It recommends, actually, it is not a tax devolution. Revenue expenditure includes what? What is revenue expenditure? It is that expenditure which is regularly going away. It has to go, and there might not be any asset which is created. It is just for the running of the process. So it is the salaries of government employees. It is continuous, na? It keeps on going. It is continuous, right? Salaries of government employees. Which of the following is a direct tax? Direct tax means the consumer pays it directly to the government. There is no one in between. Directly to the government. So which one is that? GST is an indirect tax. It is an indirect tax. Which is the direct tax? Income tax. Income tax you pay directly to the government, no? The government directly deducts it. Easy? All good? Fiscal deficit is what? We discussed in the video also. What is fiscal deficit? It is total expenditure. It is total expenditure minus total receipts excluding borrowing. So please remember, borrowing is excluded. Borrowing is excluded. The GST Council is headed by, who heads the GST Council? RBI Governor, Prime Minister, Cabinet Secretary, or Union Finance Minister? Who does that? GST Council is headed by the Finance Minister, Sitaraman ma'am. Okay, Finance Minister heads the GST Council. Okay, which article of the Constitution deals with Finance Commission? Which article deals with Finance Commission? It is a constitutional body, I told you, and it is set up by the President. 280. Please remember this number. This is Finance Commission. Article 280 is the Finance Commission. Okay, easy. Public debt forms part of. Now, this question is from balance of payments. So, public debt forms part of what? Revenue receipts, revenue expenditure, capital receipts, or tax revenue. So, public debt form capital receipts. Why? Because they create assets. Borrowing, they, on a longer term, they will create assets. That is why they are capital receipts. Okay, if there was creation of asset, no creation of asset means there would be revenue receipts like salaries. GST is an example of direct tax, incorporate tax, indirect or wealth. Just now I told you it is an example of indirect tax. GST is an example of indirect tax. Income tax. Income tax is example of direct tax. Okay, easy. Which tax is levied on import of goods? Imported goods. Which tax is that? Import of goods. Is it GST? Is it income tax, property tax, or customs duty? So it is customs duty. Customs duty is on imports. That's why we have customs department, no? Correct? Custom officers are there. Okay. Revenue deficit occurs when? When does revenue deficit occurs? When does revenue deficit occurs? When revenue expenditure exceeds revenue receipt, capital exceeds capital receipts, borrowing exceeds expenditure, or tax revenue exceeds expenditure. Obviously, when revenue expenditure is greater than revenue receipts. When revenue expenditure is greater than revenue receipts. That is revenue deficit. Consolidated Fund of India is mentioned under which article? Consolidated Fund of India. Article 280, just now we saw it as Finance Commission. This cannot be the answer, right? So Consolidated Fund of India is mentioned under Article 266. Please remember 266. Which institution manages monetary policy? So monetary policy is handled by and fiscal policy is handled by. Tell me. Monetary policy is handled by RBI and fiscal policy is handled by Ministry of Finance or government, you can say. Okay. So monetary policy is handled by RBI. The share of states in the divisible taxable pool recommended by 16th Finance Commission will be based on GST Council decision, RBI guideline, Finance Commission recommendations, or constitutional recommendations. On whose recommendation? Who will recommend this divisible tax pool? That how much from the center will go to states? I told you. So it is the Finance Commission recommendations. Article 280. Correct? Finance Commission. 280 Finance Commission. So friends, this was the main part of the Indian fiscal system. Correct? We learned a lot. We learned about all the tools of the fiscal system. Also, we practiced some MCQs. Correct? We learned about the features and types of policy, pro-cyclical, counter-cyclical, etc. Please keep viewing other videos also. Please revise these, solve these MCQs, solve more MCQs beyond this. We'll soon be meeting with other topic. Thank you everyone. Have a nice day.